Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So Tampa Bay Lightning coach Jon Cooper won the Jack Adams Award this year. This trophy goes to the NHL coach who is, quote, adjudged to have contributed the most to his team's success. So that's a fancy way of saying that Jon Cooper is the NHL Coach of the Year, and it's been a long time coming. Coop is by far the longest tenured coach in the NHL, and since he's been behind the bench in Tampa, the Lightning have made the playoffs every season except for one, and they've won 2 Stanley Cups in that time frame, and yet Coop has never won Coach of the Year. So finally, well-deserved reward. Now, I really like Jon Cooper. I mean, I'm a big Tampa Bay Lightning fan. I think most people that listen to the show know that. But I really like his approach to things. Cooper is big on what he refers to as the recipe. And by that, he means the process, the system, the blueprint. You know, hockey can be a funny game. Not funny, funny, frustrating. You know, when puck luck turns on you, you can lose a game even if you outplayed the other team. You know, I've seen hot goalies steal a game. You can hit a bad streak where goals just start coming. You know, you hit this slump. That's when the recipe is the most important. Coop always stresses the importance of sticking to the plan, even when things are going sideways. You know, sure, sometimes you do have to tweak the recipe. We're not saying you get hard-headed and stick to it no matter what. But coaches are often far too quick to panic and start making wholesale changes when things go badly. If you have a good recipe, stick to it. Keep working the plan. Keep doing things the right way, and the tide will ultimately turn. This coaching philosophy has proved very successful for Jon Cooper. And I think it is also a very wise approach when it comes to investing. So last week I interviewed Axel Merk, and if you aren't listening to our Friday Market Wrap podcast, you ought to start. I interview a lot of really interesting people in the precious metals space, and those interviews are part of that Friday podcast. And if you're subscribed to the Money Metals podcast, you're also going to be getting the Friday Market Wrap as well. Anyway, Axel is one of my favorite interviews because he takes a very philosophical approach to things. And every time I talk to him, he says things that make me think. And during this last interview, I asked him how investors should approach all of the uncertainty and volatility in the markets right now, especially given how much things swing based on, whatever the daily war headline is. And he sounded a lot like Coach Cooper. Axel said, quote, "My view is the most important thing for investors is to have a process. It does not need to be a good process. Have a process. And what I mean with that is precisely that you don't change your positioning based on every headline. Don't change your positioning based on our conversation, for goodness sake. So in simple terms, have a recipe and stick to it." And I thought it was really interesting that he emphasized that a bad process is actually better than no process at all. And I guess, that makes sense if you really stop to think about it. If you don't have a plan, you're going to be tossed to and fro by the latest headline or market function, or the current popular flavor of speculation on CNBC. But if you even have a modestly decent recipe, you're going to come out okay in the long run. Now, the thing about a process or a recipe is that it's usually based on longer-term expectations, not what might happen next week. So for me, this is kind of my recipe. Gold and silver are my saving plan, right? I'm not holding fiat currency for the long term because I know it's going to be worth less in 10 years. Now, I don't know exactly how much less it's going to be worth, right? We could have 2% price inflation over the next 10 years, or we could have 20%. We don't know. But I do know that gold will ultimately reflect that reduction in the dollar's purchasing power. Now, it might not reflect it over the next week or the next year or even the next couple of years because there are a lot of things impacting the markets. That's why you need a recipe, right? The war with Iran may drive a significant sell-off. I mean, it already has, but that doesn't change my long-term calculation, and therefore, I'm going to stick to the recipe because I am fully convinced that gold and silver will preserve my wealth in the long run. So that's why I don't panic sell when I see gold down, $150 in a day like it was on Friday of last week. And I don't get too giddy when it runs up by, similar amounts. I have a process based on how I see the economy functioning and evolving over the long term. Because that's really what I'm investing for. I'm investing for my future, right? Hopefully for my retirement. So as I mentioned, sometimes you do have to change the recipe, right? We're not talking about being hard-headed, but you should be slow to adjust that recipe. Structural shifts in the economy necessitate changes sometimes, but not based on every headline, right? You should tweak the recipe with intentionality, not based on, some kind of emotional tantrum. And really, that's the value of the process, right? It takes the emotion out of the equation to some degree. And emotion can be devastating when it comes to investing. I've felt this on my own, right? I sit here and look at the tickers, right? I look at gold and I see it on the ticker and it's bright red and it's flashing. It's down $150. And I think, oh my gosh, what's going on? That emotion is normal. Very rarely do we want to make decisions based on emotion, though. You want the process, you want the recipe, right? So Money Metals can actually help with this process-oriented approach. We can be one of the ingredients in your recipe, so to speak. We have a monthly installment program, and I've talked about it before. But for as little as $100 a month, you can build a gold and silver portfolio over time. So go to moneymetals.com and check that out when you have a chance. Because I know a lot of people, they hear me talking about gold and silver, and I think a lot of folks are like, yeah, I really should. I really should have some gold and silver. I really need this to preserve my wealth and protect my savings, but I just can't afford it. My expenses are going up. I'm getting drilled by this inflation. You can spare $100. If you can spare $100 a month, then over time you will be able to build that portfolio. And in a couple of years, you're going to have a nice little savings built in sound money. So check that out when you get a chance. But remember, you need to have a process. You need to have a recipe. So before I dig into the main subject of today, I do want to thank you for listening to the show as I do every single week. I say this pretty much verbatim weekly, but I really do appreciate the fact that you take time out of your day to listen to the show. And as usual, I'm going to ask you to help us out if you would be so kind. If you haven't done it already, you can go to wherever you listen to this podcast, to your platform, whether it's Apple Music or I guess it's Apple Podcasts or whatever platform you use. Write us a little review. Give us the good thumbs up or the 5 stars or, at least 4 stars. But that helps the algorithms and it helps grow the show and helps more people see it. If you get value out of it, other people will as well. And along those same lines, if you would share these episodes on your own social media platform, it would really help us out. And I would say thank you because I'm good like that. I say thank you. So, but anyway, I really do appreciate you listening to this show. And a little housekeeping. I'm actually not going to be having a show next week. I've been doing this now for 2.5 years. And I have not missed a week of doing a podcast. Even when I've been traveling, I've managed to pre-record or whatever. And I'm actually pre-recording this show today. I'm getting ready to go to Mexico with the group from my church. We're going to build some houses for some poor folks down there. And so I'm really excited about it. But I'm not working at all next week. So what I'm going to do is I'm recording this one. We'll have this podcast on Wednesday. I'll actually already be out in San Diego getting ready to go across the border. And then the following Wednesday, there will not be a podcast, but I will be back again when I return. So just to let you know, not quitting, just going to take a week off. So as we've already discussed, you need to have a process, a recipe. And this recipe should reflect your view of the economy over the long term. Unless, of course, you are a short-term trading kind of guy and you're just trying to generate profits from short-term market fluctuations. Definitely a place for that. Not something I do. I'm not a day trader, so I'm not primarily talking to day traders. It's a whole different mindset when you're trying to get in and out quickly and take advantage of the day-to-day price fluctuations. My analysis is more directed toward the long term. It's directed toward folks who want to protect their wealth over time, who want to navigate, the long-term trajectory of this economy. And, of course, one of the factors that drives my economic worldview is inflation. And you know that because I talk about it constantly on the show. In my mind, inflation is the main reason to hold gold and silver because they are real money. The government can't print their value away. And I know that inflation isn't going anywhere because it is literally the policy. It's the plan. Right? 2% inflation. That's the plan. So they want to devalue your dollar 10% every 5 years. So the powers that be don't want to slay inflation. They want to hide it from you. So yeah, they're going to take some action if it gets too hot and you start complaining. But they're also going to spend a lot of time gaslighting you into thinking it's not really that bad. And they do this with sketchy government-generated data that seems to prove that things aren't as bad as you perceive them to be. So you're out there saying, man, prices are just really going up. My budget is stressed. This is just killing me. And, Mr. Government Man will come up and say, well, the CPI says inflation is only 2.9%. It's not that bad. And, just think about it for a minute. A lot of people out there are feeling economic pain. And we see it reflected in survey data, right? Consumer confidence, very low. A lot of people just have a very negative view of the economy. As I recently wrote, the American consumer is broke, stressed out, and buried in debt. And I'll link to that article in the show notes. I kind of chronicle how consumer debt has skyrocketed, savings have been depleted, how people are just struggling right now to make ends meet. It's gotten so bad. I did an article last week chronicling the fact that a lot of people are starting to use buy now, pay later plans to buy groceries and gasoline. And that really wasn't the point of those things. I'll link to that article in the show notes page as well. But people are feeling that stress. We see it, we hear it. However, the official government data doesn't seem to really reflect this pain, right? There's price inflation out there, but it's not that bad. I mean, look at the CPI. It's still under 4%, so we're told. Jobs are plentiful, so we're told. We just got this, blockbuster jobs report that tanked gold on Friday. And everybody's thinking, the economy's strong. And then they'll say the economy is growing based on GDP, right? So we're told. So why is there this disconnect? If the data is saying one thing and people out there are saying another, what is this? So there's only really two ways to understand it. Either people are just imagining their pain or the data's wrong. And I think it's far more likely that the data is wrong, right? I think people pretty much understand what's going on in their own lives, right? So interesting development. There's a new AI tool, and it's called the Reality Index. And this index makes it possible to analyze raw price data without all of the adjustments that get built into government formulas. It provides a more unfiltered look at price movements, and this will be shocking to you, I'm sure. It reveals that things are indeed as bad as people are sensing. So, to kind of demonstrate this, Brownstone Institute President Jeffrey Tucker used this reality index to analyze the impact of the pandemic lockdowns and discovered that it was even worse than we thought. And I want to kind of go through his findings because there's a lesson here, right? I think his findings are important because, there's still a lot of people out there that are trying to tell you, well, the COVID lockdowns, that maybe not the best idea, but it really wasn't that bad. Yes, it was that bad. and these numbers will show you that it's that bad. But the lesson is broader than that, because it goes to show how government data can distort our thinking and how we need these tools that are kind of outside of all of that. It's tough because a friend of mine, I posted an article about this on my Facebook page, and one of my friends was like, well, duh, we know that the COVID stuff was worse than we thought it was. Why are you even talking about this? Well, I'm talking about it because when it comes to having a debate, you need to have data. And the only data we have is the government data. So we're constantly at war with this bad data. We need good data, right? If you're going to have a recipe and a process, you need to have good data to feed into it. And so Tucker's analysis here encapsulates the broader problem with using government data to analyze the trajectory of the economy. So when government started locking down economies for COVID-19, there were a few voices out there expressing concern that the impact would be far worse than the virus. I was one of those people because I understand economics. You shut down an economy, that's wide-ranging ramifications, right? But those voices were quickly shouted down, as you'll recall, in the name of safety. We can't take a chance on this. As it turns out, we should have paid closer attention to those dissenting voices. And, this goes back to one of my favorite historical economists, Bastiat, and this whole idea of the seen and the unseen, right? We had this seen virus. So we're going to take these steps, and it's going to help minimize the impact of the virus. And yet there's all of these potential unseen consequences that a lot of people are talking about, shutting down an economy. And those were ignored. We ignored the unseen. And Bastiat said that the difference between a good economist and a bad economist is the good economist accounts for those unseen potentialities. And so I can only conclude from that there are a lot of really bad economists out there. So it's been 6 years since the beginning of the lockdown hysteria, and the economy still hasn't recovered. And we kind of know this based on our intuitions. But based on calculations by Tucker derived from data parsed through this reality index, the economy lost 12% of GDP, and the purchasing power of the dollar has been cut in half in the short amount of time since those pandemic lockdowns. Think about that. That's staggering. And, the fact of the matter is, even the government data hints at a deep and lasting negative impact stemming from pandemic policies. Based on the CPI, prices have increased by 26% since the lockdowns. That's pretty significant. And at the same time, we've only seen marginal improvements in personal income, which goes to show that inflation always reaches the worker's paycheck last. The pandemic also appears to have driven some structural changes in the economy. For instance, the labor participation rate and worker to population ratio never fully recovered from the COVID era, and it continues to fall. But a 2024 Brownstone study reveals that it's even worse than the official data indicates. Now, this isn't the reality data. This is just a Brownstone study using the available data that was there. It's not surprising that the situation's worse because the formulas used by the government to churn out their data are designed to understate economic problems. This is where, I talk a lot about the fact that incentives matter. So what are the incentives for the government? Well, the incentives for the government are to make you feel like the economy is doing good, right? Because if it's not, you're going to blame the politicians and you're not going to vote for them. And their primary motivator is getting reelected. So according to this 2024 Brownstone study, the economy has remained in a technical recession since the lockdowns were lifted. According to Tucker, the study's authors came to this conclusion with some limited adjustments of price data bumped up against output data. Now, you will be shocked to learn that the mainstream denounced the study, called it extremism, and fell back on the official data, which, by the way, is bad enough. Now, if you're a regular listener to the show, you know that I'm constantly pointing out the fact that we should take this government data with a grain of salt. And I always mention that the CPI formula was changed in the 90s so that it would understate price inflation. So if you took today's raw numbers and ran them through the CPI formula of the 70s, you would get a CPI that's nearly double what we're seeing reported today. Jobs data, that's always sketchy too, right? There's constant revisions, usually down, sometimes up, but it just makes all of this data seem like, And in his article, Tucker makes a really good point. The formulas themselves create the potential for, I don't want to say lying, but covering up the reality, because all of these formulas depend on assumptions and, birth death models and all of this stuff that is overlaid on top of the price changes. So Tucker asks the operative question. He says, where does this leave those of us who are looking for a plain index of prices? A veil has been put over that basic question and answer, such that we don't know for sure. This matters tremendously for issues like raises, examining cost of living increases, taxes, and pension payments, because everything is adjusted for inflation to convert it to real valuations. But if we don't have a clear number, what are we to do? So Tucker digs deeper. He uses this reality index, and as he explained it, quote, an independent intellectual in Madrid, Tom Elliott, has deployed tools of AI to wholly reconstruct price indices in a way that is consistent with actual prices. His results are absolutely eye-popping. So basically what this does is the AI methodology strips away all of the hedonic adjustments and all of the suppositions from the government data and uses raw prices reported by the Bureau of Labor Statistics to get a trajectory of prices without all of the biases that are injected into these formulas. And Tucker explains the result this way, quote, we find that a basket of goods and services that cost $100 in 1980 costs $515 per the reality index in 2025. The official CPI reports only $391. That means that real prices have run 32% higher over 45 years than the government reports. Over a 55-year window, the reality index ran 54.4% faster than CPI. So when we zero in on the post-pandemic era, we see that the impact of the lockdowns was even worse than the already bad data indicates. Based on the reality index, there has been as much as a 50% decline in purchasing power since 2019. Conversely, this means that COVID cut the value of the dollars in terms of purchasing power for goods and services to half its former value. The official CPI will tell you that prices or that inflation has run about 26%. So the reality, according to the reality index, is about double what the government data is telling us. So Tucker then took this data and he asked his AI to map it in terms of year-on-year changes with using the reality index and to basically parallel what we're seeing in CPI. And this is what he got. Quote, CPI shows a peak in 2022 followed by a decline in the rate of increase. Reality index shows that the devaluation actually intensified and never fell below 6%. In other words, according to the reality index, we've never gotten below 6% inflation. That's pretty shocking, right? Because the CPI tells us it was down around 2 point something for a while, right? So Tucker goes on to say, this explains so much about consumer sentiment and political shifts. People feel it even if official data never revealed it. This kind of chart forces a rethinking of the history of the last 6 years. And indeed, I would go further and say that it requires a rethinking of the history of the last 50 years, right? So if you take that reality index data and then plug it into a GDP formula, you'll find that the 2020 recession never ended, right? You can see it on a chart. We see negative GDP in all but 3 quarters since the summer of 2022. Tucker calls it a, quote, recession without end. Quote, overall, Grok AI estimates a loss of 5 to 12% of GDP from 2019 using the present reality index numbers. He went on and he said, sorry, but read that again. So I'll read it again. Overall, Grok AI estimates a loss of 5 to 12% of GDP from 2019 to present, using the reality index numbers. So he says, instead of any recovery, we've seen as much as double-digit declines in GDP overall since 2020. This is the cumulative loss spread out over 6 years. That's roughly half of the losses of the full period of the Great Depression, which was more catastrophic than people know. Now, Tucker does concede that anyone can look at the methodology and disagree, right? As the data is subject to replication. And he goes on and he says, be my guest. From what I can see, the actual picture is far closer to the reality that most people are experiencing. And he's absolutely right. These reality index numbers erase that disconnect between what we hear consumers saying and what the data is showing. So the bottom line is we should be skeptical of government data, and we should continue to do so. The people in power have a vested interest in making things seem better than they are. After all, they're the ones that we're going to blame for our pain, right? As it stands, we can feel the pain and complain about it, but the government people and their enablers in academia and the media are just going to point to the official data and tell us it's our imagination. They're going to keep gaslighting us. And that's the beauty of independent data crunching. That's why this is important. And that's what I told my friend who kind of challenged this on Facebook. It pulls away the government veil and reflects the reality that we're all experiencing. And of course, it also gives us a foundation to develop our investing recipe, and it helps us to cut through all of the headline-driven noise. Now, speaking of recipes, another thing that is important to my recipe, another thing that's driving my thinking, is the Federal Reserve's Catch-22. And again, if you're a regular listener of the show, you've heard me use that phrase over and over again. It goes right along with the inflation issue. And over the last couple of years, I've honestly felt like a voice crying in the wilderness when it comes to this, right? Everybody just seems to ignore the debt black hole, and then they just assume that the Fed can raise rates. Well, it's not that simple, right? And there are some mainstream folks that are starting to see the writing on the proverbial wall. In a recent interview with Kitco News, Sprott Incorporated President Ryan McIntyre said the Fed is, quote, walking a tightrope. I've used that very same phrase. And he said they have very few viable policy options. And he said that this scenario will ultimately drive investors to gold. And, you know, I'll sum it up again. I've done it many times, so I'm not going to go into depth. But as I've talked about several times during recent shows, mainstream analysts assume that the central bank is going to hold rates higher for longer due to the inflationary pressure introduced by the U.S.-Iran war. There's even growing speculation that the Fed is going to raise rates this year, and several Fed officials have started laying the groundwork for that rate hike. However, again, it's not as simple as that. An economy dominated by a debt black hole does not function very well in a high or even a normal interest rate environment. And the central bankers at the Fed face a tough choice, right? They can keep monetary policy tight. They can hold rates higher for longer. They could raise rates to tamp down price inflation, or they can ease monetary policy to take the pressure off of this debt-riddled bubble economy. Both of those are legitimate moves given the current economic situation, but they can't do both. And that, ladies and gentlemen, is the Catch-22. McIntyre said, we've never faced a situation, quote, where everything is like walking a tightrope. He said, you don't want inflation, so you have to keep rates somewhat high. Conversely, you don't want the economy to slow down too much, so you've got to keep rates somewhat low. And he emphasized that this is a precarious situation, and it puts the Fed in a, quote, tough spot. Seems like an understatement. McIntyre says, and by the way, if either of those things goes too far out of range, then you risk losing control of bigger things. That's kind of the warning, right? McIntyre said it was a coin flip whether the central bank would hike rates before the end of the year, but he also said he thinks pressure on gold from the threat of higher yields is temporary. He argues that the structural bull market remains intact because there is a bigger problem than inflation, the aforementioned debt black hole. Quote, to me, the most existential threat remains the sovereign debt risk. In other words, government debt. Yes, there it is, the debt black hole. Finally, somebody out there is acknowledging that it's a problem. Axel and I actually talked about this during our interview last week, and I asked Axel why the mainstream is ignoring the debt problem, and he made a good point. We can't quantify it, right? We know intuitively the debt is a problem. We know that borrowing and spending is unsustainable. We know this because of economics. What we don't know is when or how the debt bubble will pop. And the government has had a remarkable ability to kick the can down the road. Remember, people were up in arms about the national debt in the 80s. And I think that is part of what kind of makes people ho-hum this subject, right? Oh, we've been talking about the debt for, 50 years. It's a fine, right? Nothing's happened. And since we can't quantify or predict when it will play out, the markets really can't price it in. So it just gets ignored. But you ignore it at your own peril because it will have an impact, however unpredictable and unquantifiable that might be. McIntyre said, given the Fed's conundrum and the reality of the debt black hole, quote, all roads lead to gold. He said, the longer we spend not addressing our spending problem, the tougher the road is going to be. And again, there's only one thing that's sort of at the end of that equation, and that's gold. And he's absolutely right? The bigger the debt gets, the more difficult it becomes to try to fix it. But politicians don't care, right? Politicians are motivated by short-term incentives. They want to get reelected, and they don't want to cause the pain that it would take to really get the borrowing and spending under control, because you'd have to cut a lot of programs, and that would hurt a lot of people, make a lot of people mad. It's necessary, but nobody wants to do it. They're content to just keep kicking the can down the road so they can keep getting elected month after month. So they're going to increase spending, right? They want to bribe you to vote for them. That's the bottom line. That's where we are. McIntyre noted that despite the 2-year bull market in gold, most Western investors remain dramatically underallocated to the precious metals sector. And meanwhile, gold ETF holdings remain below all-time highs. And his point here is that the underlying bull market is still there, right? There's still a lot of room for people to buy gold. And we're seeing a gold rush in the East, in the Asia, and the emerging markets, not so much right now in the West. And we've talked about this before. Even a modest increase in gold and silver holdings by mainstream investors in the West is going to significantly boost demand for those metals. And so that's why we're saying that there's still plenty of room for this bull market to continue. And as we've talked about on the show before, there are now some mainstream investment types that are saying, you know what, maybe this 60-40 allocation, 60% equities, 40% bonds in a portfolio isn't good enough. Maybe we need to do 60-20-20 and cut 20% of that bond allocation and add 20% of gold. And very few people have done that. If people start moving, if that becomes the mainstream mantra, you're going to see a huge increase in gold demand over the next few years. And McIntyre points out, and I agree with them, that gold is one of the few assets that's positioned to benefit no matter what the Fed does. He says, quote, the options narrow in terms of what you can do, and that's why we continue to think that all roads will lead to gold, right? If we have an economic crisis, gold's going to be good. If we have higher inflation, gold is going to be good because it's going to help preserve your wealth. So that's why gold needs to be part of your recipe, and silver as well. So now's the time, right? We're having these dips. We're having this downward pressure on prices because of the war. I think this is a buying opportunity. I've said that before. I still believe it. Call 800-800-1865 today. Talk to a Money Metals, precious metals specialist. Ask them questions. They'll help you. That's why they're there. They want to help you. They want to help you understand how gold and silver can be part of your portfolio to protect your wealth, to strengthen your financial position. They're great, knowledgeable. Give them a call today. If you don't want to talk on the phone, you can always go to moneymetals.com and chat with the precious metals specialist online. Or if you just want to buy, you want to get, some gold eagles or silver eagles or whatever it is that you want to get, you can find those at moneymetals.com. You can purchase online, make your payment. We'll ship the metal right to you. Or we'd be happy to store your metal in our state-of-the-art bullion facility if you don't want to hold a bunch of gold and silver in your house. But do it today. Time is going to run out on this, right? Can't quantify when the debt black hole will suck everything into it, but that's what black holes do. So that is a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything I've talked about on the show today and a whole lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your email inbox, make sure you sign up and get on our email list. Of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, as I've already mentioned, make sure to tune in to our Market Wrap podcast every Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold, silver, economics, and investing. Thank you again so much for listening to the show. Remember, I will not be here next Wednesday. I will be in Mexico building a house, but I will be back the following Wednesday and then moving forward. So thanks for listening again, and we'll talk to you again soon.